Hi, everyone. I'm Ivan Buki, and welcome back to Wall Street Silver. Joining us today is Michael Pento. He is the president and founder of Pento Portfolio Strategies. Welcome back, Michael.
Thanks for having me back on, Ivan and Jim. Good to be with
So,
you.
Michael, you're always one of our most popular guests. Your videos really outperform on our channel. The audience loves you because you're a straight shooter. And one of the things I wanted to ask you about is in the gold and silver world, we're sort of looking for is the Fed going to pause on their interest rate hikes? Are they going to pivot back down to easy money? Because a lot of people are thinking that's when gold and silver are really going to launch, when they have some sort of hint that the pivot's coming. And I know you're all over this topic. I wanted to get your take on it right up front.
Well, thanks for your kind words. I don't know why I'm so popular. I can only imagine that people understand viscerally that I'm just trying to make people money. I'm not trying to sell anything. Just want to make people money. So when we talk about a traditional pivot from the Fed, you're talking about a Fed that's cutting interest rates by hundreds of basis points. So in 2000, you're talking about 500 basis points, 600 basis points. 2008, you're talking about another 525 basis points. That's a traditional pivot when the Fed goes from a very high level of Fed funds rate back to zero. And in recent history, a true Fed pivot involved quantitative easing, quantitative easing to the tune of $220 billion a month of an increase in the base money supply. So now Wall Street's talking about a pivot, and maybe some gold and silver bugs are, jumping at the bit or chomping at the bit, as they say, trying to front run the Fed. Now, I think that's going to be the buy of the century, precious metal stocks, the buy of the century. But it's going to happen probably in the spring of 2023. It's not now. A Fed pivot now is one that we hope, at least the gold bugs, precious metal bugs are hoping, the Fed pivots from hiking by 75 basis point increments to 50 basis point increments. And all the while stepping up QT, quantitative tightening, to $95 billion a month. Now think about that. Here's the real reason why the Fed cannot pivot anytime soon. And even when they get to their plateau, their neutral level of interest rates, which I believe is going to be close to 4%. So say 3.5% to 4% on the Fed funds rate. They say they're going to leave it there. They're going to stay there because they don't want to make the same mistakes that they did in 1970, which is they start and stop this rate hike and rate cut regime and engender 20% inflation, which is what they already. But by the way, that's what they've already done. But the real reason is this: they understand that people can no longer afford to own a home. The rents in Manhattan are up 46% year over year for a cage in Manhattan. Okay, a cage, not some elaborate palace. 46% for a hole in the wall in Manhattan year over year. So home prices are up 66%. Home prices, nominal home prices, are up 66% from their apex in 2007. 2006, 2007, and they are up 43% in the last 2 years.
Wow.
So rents are unaffordable, homes are unaffordable. It's directly at the feet of the Federal Reserve. They printed $4.5 trillion to buy mortgage-backed securities and treasuries. They blew up the housing bubble. They made the middle class and the lower classes, they put them into penury when it came to paying for energy and food and shelter costs. And they realized their mistake, and they're going to go to 3.5% to 4% by early 2023. That's from zero. I mean, they were at zero in March of this year. So on a rate of change basis, that's like mind-boggling. The Fed has never gone from 0 to 4% and doing $95 billion in QT at the same time. That is not a good environment that you want to, as far as gold is concerned and precious metals. When you look at the level of real interest rates, so nominal rates are rising, and you're going to get some deflation, which adds to interest rates, the real level of interest rates. That is not good for gold, and that is the reason why we've gone through this truncated period of pain, acute pain in gold and silver. But it's coming to an end in the spring, probably, of next year. I'm not making a commitment to that. I'm saying probably in the spring of 23, that all ends when the economy completely falls apart in the United States. The dollar tanks against even the euro and the pound and the yen. The Fed starts lowering interest rates because they have to re-liquefy the credit markets. The credit markets will most likely freeze by then. And if that is indeed the case, you're gonna want to load up on precious metals. Sorry for the long answer.
Oh, no. Your answer.
That was awesome.
We appreciate your answer. And I want to point out to the audience, we've probably had you on 4 or 5 times in the past year on our channel. And I went back and I watched some of our older videos. You called everything that's happening right now. You called it 6 to 12 months ago in previous videos that we did. So when you tell us, when you come out and tell, say these things, I take it really seriously because, you've been calling this market dead on for the past year.
I just put the odds in your favor. What are the odds saying that you should be doing? Mm-hmm. You're not always going to be correct, but what are the odds saying? The odds saying that the next phase of this bear market is going to be marked by lower treasury yields because of the global recession. So a higher dollar, even from here, lower interest rates, and much lower stock prices, which are still very expensive historically speaking. I just want to add this to you, and I'm sorry, I can't let you guys ask the question, but the total market cap of equities as a percentage of GDP right now is higher than any other time since the signing of the Buttonwood Agreement in the 1700s all the way to May of 2020. Wow. We have never seen a stock market, the valuation of equities as compared to the economy, higher than it's been since the start of the creation of the stock exchange to May of 2000.
That's like the Warren Buffett indicator, right? The ratio of the Wilson, the one of those stock indexes, total stock indexes to GDP.
Wilshire 5000 is GDP.
Yeah. The Buffett indicator.
I'm not just talking about nominal. I mean, nominal terms, it's through the roof. I don't like to look at things just at nominal terms. I look at nominal terms in relation to incomes, nominal terms in relation to GDP. So when I look at home prices today, if you look at longtermtrends.com, home prices today are much higher as a percentage of incomes. So it's over 8.3 or 8.4. The apex of the bubble was 7.1. Home price to income ratios are much higher today than they were at the apex, the apogee of the bubble in 2005 to 2007. So I know home prices. The mortgage industry, the underwriting standards are much better today than they were in the lead up to the Great Recession. I get that. But 20 to 25% of home ownership is speculative. In other words, they're owned by investors or Wall Street. And the home price, in nominal terms and as a percentage of income, are much higher than they were in 2007. So watch out for home prices. If you think that the Federal Reserve can nail inflation in any asset class, be it stocks, bonds, or real estate, obviously they've proven they're completely feckless in that nature.
I live in Florida, and we've noticed it here. I bought my house in 2019, and it's probably doubled in value in the past 3 years, just locally. I'm not complaining, but whatever. But I know incomes haven't doubled in those 3 years, so a lot of people are crying around here about rent and home prices. Everything's becoming unaffordable. But back to what you were saying with the European Central Bank, they're also finally, they've been at negative interest rates for a long time. Just a month or so ago, they raised it 50 basis points to 0%. They raised rates to 0% to fight inflation. And so just the other day, they just raised it another 75 basis points, and an incredibly hawkish, socialist European European Central Bank President Christine Lagarde, Madame Inflation, she's now getting all hawkish. And my concern there is Italy and Greece and those types of peripheral Southern European countries with insane debt levels.
Mhm.
Do they blow up? Or I mean, do you sense maybe a European debt crisis if the Fed gets if the European Central Bank has to get really hawkish raising rates?
Yeah, there's a lot of problems out there in the world. This is not a unique problem to the United States. Inflation and anemic GDP growth is not at all unique to the United States. Look at Europe. In when you were talking about interest rates, you're talking about nominal interest rates. You're talking about real interest rates. You're talking about nominal rates that were negative and now struggling to get back to 1%. We just saw a couple of days ago, like you said, a 75 basis point rate hike from Madame Lagarde. She said there's more rates coming. They might not all be 75, but there's more coming. But she's hiking into something very unusual. This is very unusual. So she's sort of terminated that asset purchase program, but she has a little twist where a twist in that where she will sell German bonds and buy Italian, Spanish, Portuguese, and Greek bonds, try to keep those spreads tighter. So that's what she'll try to do. She's threatened an unlimited amount of that twist, selling German, the German and French debt and buying periphery debt. But I don't know how long she could really do that and still try to protect the currency. The currency's in free fall. And by the way, you want to talk about a free falling currency? Look at the Japanese yen.
Oh yeah,
it used to be the U.S. dollar. So the Bank of Japan is faced with a very big dilemma. They could either continue to cap interest rates going out 10 years on JGBs at 0.25% on the quadrillion yen outstanding debt, or they can defend the currency. They can't do both. I mean, they cannot do both. So they have to either let the currency depreciate as they continue to print money to buy JGBs. They're the only individuals that will cap that rate. Will ever buy a Japanese government bond yielding 0.25% is the Japanese central bank.
Yield control, yeah.
Yield control. But when you do that, you destroy your currency.
right.
And they're very close to losing complete control of the currency. And if they say, okay, we can't do this, we have to stop printing yen, and we'll defend our currency, which is, I think that's a possibility that they might be forced into doing that, especially for a nation that's an island nation with almost zero natural resources. They have to import almost all of their food and energy, a tremendous proportion of it. So when they do that, then where would you think a Japanese government bond should be if left to market forces?
7%, 10%, something like.
I don't know, but it's close to double digits. Let's just say that, close to double digits. And it could happen rather expediently if they make that calculation that they're going to defend their currency. So these are the problems that exist all over the world. Now go back to Europe real quick. I mean, Madame Lagarde is sitting there saying that we're going to raise interest rates by 75 basis points after 50 basis points. And we'll continue to defend the value of the euro and fight inflation, which is much higher there than it is in the United States because of the problems with Russia and the Gazprom pipeline and having very limited access to natural gas over there. But let me ask you a question: in what context does the ECB have to hike rates so aggressively? Into a recession. Europe will be in recession in Q4 of this year and the first part of 2023. This is a very unique environment that we see very hawkish central banks that have gone very quickly from expanding their balance sheets, printing money, to now burning money supply and rapidly raising interest rates into a global recession. And here's the other thing I want to mention quickly, as I want to underscore this point. I just mentioned it before. They are doing this into asset prices that are at record highs.
Yeah.
And are very vulnerable to a collapse.
Very vulnerable. And the new Prime Minister of the UK, along that same theme, she just announced £130 billion bailout for consumers and another 40 billion for small businesses. So they're just going to start printing pounds. The European or the Bank of England is going to start. They don't have the tax revenue for this. This is just to put this in perspective. This is the equivalent of the United States doing probably $1.3 trillion.
Jeez.
Something like 10 times this amount in relative, GDP relative to GDP. If we were to do the same, they've capped energy bills at 2,500 pounds a year for people, which is like, hey, hot showers for everyone. I mean, so there's not going to be any demand destruction. Everyone's going to be enjoying their hot showers this winter in England because their energy bill's capped. Who cares, right? I'll just use it.
This is the plan from governments to fight inflation, to hand people money so they can pay for commodities that are in short supply. I mean, and here's the other ramification of that. The only country on the planet, really major developed country on the planet, that isn't doing something like that, subsidies any longer, to the extent that's happening in Europe and in the UK, is America. Okay, we are burning money supply at $95 billion a month. Twice the rate of QT that we did in 2018 and 2019, which, by the way, ended in disaster. It ended in disaster. It crashed the equity market and then end up freezing the repo market. Okay, so we're heading in the same direction here. And think about the strength that we're putting in the U.S. dollar, which is already soared. Okay, a lot of people, we talk about the dollar being a flawed currency, and it is doomed in the long run. It's losing its hegemony in international trade. A lot of countries like Russia and China no longer want to have their reserves in the dollar because they're subject to sanctions.
Right.
Yeah.
So that's happening. That's longer term, but short term, the upward pressure on the dollar is still immense. And what does that do for corporate earnings and multinational? But the earnings forecasts still for 2023 are for earnings to grow. This is despite the coming recession. We had a short recession in the first half of 2022. We're going to have a little bit of growth in the Q3 of 2022, and then it's just downhill from there. We had a massive inventory build. The inventory to sales ratio is a flagpole.
Right.
So when you burn through inventory, it's a reduction to GDP. And we haven't seen the negative effects on the consumer from the borrowing costs shooting up from 0 to almost 4% in the space of 1 year. And we haven't seen the damage done from asset bubble and the reverse wealth effect occurring from the destruction in bonds, equities, and now the incipient destruction in real estate prices. One more point I want to make about asset price destruction. If you own long-term treasuries, a risk-free asset, you're down more this year, about 26, 27%, than the NASDAQ is down. That's a fact.
Wow.
Yeah, so this could there's a lot coming down the pipeline at people right now that I don't think they're ready for. So Michael, the Fed is still, even at this point, making noise about a soft landing being possible with no recession. So are they serious? Do they really believe it themselves, or are they just making happy talk for the market at this point?
Well, I mean, if the Fed's batting average with soft landing was in the major leagues, they'd probably be sent to the little leagues because their batting average is close to 0 with soft landings. And think about what I just said about the soft landing scenario as far as the extent of asset bubbles. When have we ever had a triumvirate of bubbles that existed concurrently? So equities, bonds, and real estate of massive proportions in those bubbles. And if you look at the pace and the rate of change of Fed monetary policy, it has never been this hawkish in history. So if you have record asset bubbles, record debt, record margin, and you have a record pace of monetary tightening on top of that, the chances of a soft landing are almost 0. So why would I mean, again, this is all about the odds. I don't know everything. I'm just saying, let's just think mathematically and think logically. What are the odds of the Fed engendering a soft landing when they are the most hawkish central bank in history, as
Mhm.
far as monetary tightening is concerned, with QT in combination of the rate of change of interest rates, on top of asset bubbles that have never existed before concurrently, those three that I mentioned, stocks, bonds, and real estate. So soft landing to me is almost impossible.
Yeah, I would agree with that. I would definitely say you're correct. But you know, you did say that you think Q3 we might have a slightly positive GDP number. So, you know, would that give them the ammo to say, "Oh, recession's over. We were right. There's no recession coming." The two quarters of GDPs doesn't mean recession anymore.
Yeah, they can say, they're going to say that. Of course, even Madame Lagarde isn't predicting a recession in Europe. Powell has never come out and admitted that we were in a recession. He's certainly not predicting one for Q4 and the beginning of 2023. But a recession is coming. If you look at the housing market, you know, let's look at housing refinancing. This is when you go to your bank and you say, I'm going to take money out of my house for consumption purposes, and then I'm going to lower my interest payment on my loan and add further to my consumption. This is the practice that's happened since 1980 until recently. Year over year, those are down over 80%.
Wow.
Yeah.
Almost zero. And applications to purchase a home are almost down 25% year over year. Applications to purchase a home. So if you're a bank and you make your money on loan, you know, you borrow short and you lend long, you're not lending long anywhere near where you were before. And now you're just looking at losses on your portfolio. So this is a very bad situation for the stock market, which is, again, as I say, 17 and a half times forward earnings, which is very expensive. And the forward earnings that they think you're going to get are way too optimistic.
Yeah. Well, Michael, thanks for coming on. We really appreciate it. You know, I listened to what you say, and I wish we were more optimistic about gold and silver, but I totally get it that the moment's probably not right now. And we're definitely going to have you back on in the next few months and get your take on these things.
Well, I'll give you a hint. When the initial jobless claims start spiking and the non-farm payroll reports start coming in negative, and the economic data is going to be absolutely horrendous.
That's when they pause.
That's my belief. And that's when the dollar will start to tank in anticipation, way before Powell agrees for any kind of pause, or even has to reverse course. You'll see precious metals in the vanguard there, sniffing out the weakness in the currency.
Yeah.
Of course, if you have $100,000 to invest and you're a U.S. citizen, I'll take care of that for you here at Pento.
I'll add your link. I will add your link into the description, so people can find your website. Thank you, sir. We appreciate it.
Thanks for having me on, guys.